And Kate, do you have a new speaker for me?
Yes, we've got Eric Gebhard in the room.
Hey, Eric, how you doing? Eric, can you hear me?
Yes, sir. I did so. Hopefully you got me now.
I got you now. Always welcome. Happy to speak with another USC grad.
Yeah, no kidding. Yeah,
Oh, Trojans.
they're making some headlines this year with football, seems.
Actually drove through there just a few weeks ago. So it's always nice to see Von Kleinschmidt Hall and some of the others
Yes.
there.
Yes, the Von Kleinschmidt Center. That's right.
Okay, Eric, why don't you go ahead and put up your PowerPoint? I'll give you a quickie introduction here. Upon graduation from the University of Southern California with a BS in Business Administration, Mr. Gebhard acquired his Series 6 and 63 securities licenses and worked as an account executive with a mutual fund and insurance group. He then turned his efforts to the futures markets, earning his Series 3 commodity futures license with an options specialty firm. He subsequently worked at two other futures brokerage firms before co-founding AltaVest in 1997. After several years, AltaVest developed a large client base of options traders. The AltaVest team saw a need to make complex option spreads simple. They developed the Theta Trader, which pre-selects complex multi-legged options trades on stock indexes and automatically manages the risk and reward. The Theta Trader technology allowed for the creation of a unique six-legged option spread called the Dragonfly. Theta Trader also utilizes an integrated trade alert functionality wherein to respond to an alert, the client only needs to touch accept or reject on their smart device. Mr. Gebhard also worked to make automated futures trading systems available to AltaVest clients via a user-friendly platform called AV Systems. The purely algorithmic-driven systems on the AV Systems platform, as well as unique option strategies, offer a non-correlated investment opportunities. Mr. Gebhard enjoys spending time with family on adventurous outings, along with vintage automobiles, bike riding, and church activities. He also volunteers as a member of the Dean's Advisory Council for La Sierra University's Zapara School of Business. So did you manage to go anywhere interesting on vacation this year?
Well, we went to the mountains and did some water skiing, so that was a lot of fun.
Was that like Lake Arrowhead?
That's exactly where it was.
That's a nice place.
It is. It's like a completely different world up there, just a couple hours away.
Totally. All right. Well, you know the drill. You have until 5 minutes before the hour. I'm going to go ahead and mute myself, and I will be listening in.
Yeah, great. And I assume you see my screen okay?
Yep, there it is. Simplify
Okay.
your options trading using proprietary automation.
Okay, let's get started. Thanks, John. And we're going to talk about options trading using our proprietary solution. We're going to look at pre-built option trading with automation for risk and profit management. We can use strategies for hedging, whether it be directional or even non-directional strategies. And we have one-touch trade alerts, very unique approach to trade alerts. You've never seen anything like it, at least I never have. I've got a lot to get through. So thanks again for Mad Hedge for having me. A little bit of the preliminaries here. Remember, we are speculating and we always accept risk when we are speculating. So anytime there's a chance for profit, there's always risk. So do take a moment for reading through that risk disclosure. Remember that all funds committed should be risk capital when you're trading with futures and futures options, and that past performance is no guarantee of future results. A little bit about who we are. We are AltaVest since 1997, so 25 years now as a introducing brokerage firm. We traded tens of millions of contracts over that period of time. There's yours truly there in the middle with some colleagues down on the S&P 500 options trading pit. And we're a brokerage firm. We are in a highly regulated industry. We're audited at least yearly. and we're registered with the CFTC and a member of the NFA, and we're located in California. And I've been doing this about 30 years now, started in 1991 when I became licensed, and I'm a USC graduate, like John mentioned. So go Trojans. Maybe you've seen some of our other presentations over the last few years. And with that said, let me go ahead here. Oh, I forgot this part too. I began in mutual funds. And so I was licensed with mutual funds and annuities with my Series 6 and 63 securities licenses. And I'm currently licensed with my Series 3 license, as well as Series 65, which is the investment advisor law exam. So now let's dig into the presentation. There's a lot to go through. So if I go quickly, especially near the end, don't worry about it. A lot of it is just imagery and pictures. But there are 3 common barriers that we kind of have identified here, at least from our client feedback. How do you trade in really any environment? You know, there's always volatility. What about day trading, stock picking, trading the chop with individual stocks? And I didn't hear John's presentation. I know others as well in the program here are stock pickers, but that's not what we do. So we don't try to trade individual stocks at all. And here's some studies here talking about day trading, less than a 1% success rate. Let's take a look here. Here's a study that less than 1% of day traders over a 15-year period of time were consistently beating the market. And here's a Charles Schwab study here over a 6-year period of time. Active traders substantially underperformed a simple low-cost indexed fund. And you know, clearly these stats here, I think they might be somewhat valid, but you know, look at the pool of people they're looking at as well. They don't have a lot of research and tools available to them, most likely. They probably jumped in as rookies as well. So, but even professionals struggle. 2021, 79% of active fund managers underperformed. Over 10 years, 86% of active fund managers underperformed. And you know, a lot of that has to do with the mandate of the fund as well. So it's not necessarily the manager that's always at fault, but nonetheless, look at this. BlackRock, first half of this year, they lost $1.7 trillion. So even the big guys were struggling this year. So what do we do? How do we trade in this environment? Maybe we got to listen to social media, but maybe not, because being popular means you never criticize. You're always bullish, basically. 2/3 of adults who have been investing for less than 3 years use social media to make stock trading decisions. So a lot of rookies out there in social media. This guy here says, you want 100 grand, you can make money out of thin air with real estate. This guy's here with his Rolls Royce talking about making 750K. But Bloomberg points out the day trader army during the pandemic, they've lost all the money that they made on the rally. Amateur investors jumped in and they've given back all their gains, according to Morgan Stanley. So like this poor guy here, he got 500,000 from his parents, and now he's lost 96%. So let's try not to do that, folks, and not a good idea. And I'm going to pick on Jim Cramer and the ARK Innovation Fund only because they're so well known, but really this could be any talking head or pundit. Jim Cramer says here the bear market is over, March 25 of this year, right here where this red arrow is. And of course, it's not over. It just sort of got some steam actually after immediately he said that. Here's all the times he says, you know, it's a bottom now, it's another bottom. Now it's the bottom, now it's the bottom. And, you know, on and on and on. So I guess you just keep saying it long enough, but that's not much of a process. And here, just a few days ago, he says here, I still believe we've seen the lows. Well, okay. Well, you know what happened a couple of days later, had the worst day ever, stock sell-off, down 4%, 56-to-1 ratio of stocks being down to up, worst decline in 2 years. And, you know, of course, we haven't made yearly lows or fresh yearly lows yet, but something to think about there. Kathy Wood says the bottom occurred on January 27, right here at this arrow. Of course, we've been dropping ever since. Biggest monthly outflow in their ETF, down 60% this year. And it looks like Bloomberg here, I noted this just the other day, they go on the dip buying spree, biggest binge since February. So we'll see how that turns out. What about crypto? Is there a place to hide in crypto? Well, you know, there it seems to be highly correlated. Everything goes to one when when the asset classes and stocks and traditional assets fall. Bitcoin, not a place to hang out for safety, that's for sure. This gentleman here says he might be down 10,000 today, but maybe he'll be up $1 million in a year from now with his crypto. Nonetheless, that's all called storytelling and narrative, selling a narrative. It's kind of sexy to talk about that type of thing, especially if you're younger and inexperienced and things like these untested coins and so forth. But having said that, what can we do to really beat the market? Well, it's not that easy, folks. Turns out some of these hypothetical back testing here with what they call monkey portfolios, they run back testing. 96 of the 100 monkey portfolios beat a generic cap weighted index, outperformed the benchmark by 1.7% per year. And I like this guy here, so I always include him or her. There's your best fund manager right there, folks. So really, number 3 in terms of the hurdles would be us. Our own emotions get in our way. It can be expensive trying to convince the markets that you are correct. Ed Sequoia, he's in the book Market Wizards. He's a system trading, basically an algo trading pioneer. So let's avoid this. You don't want to end up muttering this. So when you're on your deathbed, still thinking that you were right and the market was wrong. Let's stay off of that roller coaster or that cycle of emotions. I know we all get on this roller coaster ride. It's even after doing it for 30 some years, we still find ourselves, having difficulty at times overcoming those emotions. You're euphoric when things are doing great. You're despondent when they're not. You get optimistic again. Of course, we're all human and that's easy to do, but we have 3 common biases because we become our own worst enemy. We've got confirmation, anchoring, and recency bias. That's just sort of endemic to the, really the human condition. This kind of meme here summarizes it though. I think we tend to get overconfident when maybe we shouldn't. But remember, algos are dominating the marketplace now. %90 of the stock market trading, according to JPM, is systematic or AI or machine driven. So that's what you call revolutionary trading. We're now in this AI age or machine age, that's for sure. This is what it used to look like. Quick video I took visiting the trading floor years ago. But certainly it's not like that anymore. This is what it looks like now. We're going to talk about options trading using machines and algos with no emotion, run automatically, built-in controls. But before we do that, a little bit of context as to how maybe an insurance company would trade options. Well, you know how they work and operate now. They get paid premiums to assume risk. They sell and manage time. They insure themselves by hedging. They're consistent and patient. They have a process that's very important, folks. And they look at probabilities, favorable long-term mathematical probabilities. They simply look at statistics and actuarials, number crunching. So how can we sort of mimic what an insurance company does with options trading? By collecting premiums, trying to generate base hits with our trades by selling short these options and collecting premium. You need to be consistent, patient. You will have losing trades. How do you manage those trades? How do you manage the reward, just as importantly? And you need the proper tools to make this happen. Remember, we're looking for base hits when we're collecting premium. We're not swinging for the fences. So these are short option strategies for premium collection. And quite frankly, you can use these in non-directional markets, bullish or bearish. And you look at targeted outcomes that have predetermined risk. And that's called a credit spread, where you collect premium. And these are insured positions, meaning covered, predetermined risk and reward, and they can be non-directional, like I mentioned. And we trade options on the stock index futures, not individual stock options, and I'll give you 3 reasons why. First of all, an index is less volatile than an individual stock. And there are, of course, strategies for all directional or non-directional conditions when you're using option strategies. And then if you're trading an index, you're really just looking at one market, that particular index, or maybe two indexes or three. You're not looking at the 6,000 or 7,000 different securities available. And there are definite advantages to doing credit spreads with futures options on the stock indexes. And I'll show you in just a second, but don't worry about this chart right now. But you can see the upper range here, the lower range or boundary for this particular trade. And you kind of have this wide margin of error here. And I'll show you that in a demo. Before we jump into that, quick primer on the Greeks. Delta. So that's how much the option value will change with a change in the underlying asset. That's really simply what that means. So it's also the approximate probability of an option expiring in the money. So here is an example. If your delta is 0.25, that means there's a 25% chance of expiring in the money and a 75% chance that it would expire worthless. That's what the math tells us. Remember, delta is always moving with price and time as well, and it is not the probability of a winning trade. So keep that in mind too. And then there's theta. Theta represents time decay. Remember, options are a wasting asset, as they call them. They have a limited lifespan, as we know. Everything has an expiration date. So when you refer to theta in options parlance, that's just a reflection of time as a negative number equaling 1 day of time decay. So if an option premium is 10 points and theta is negative 0.05, the next day the premium is 9.95, and the next day after that, 9.90, and it tails off from there. Of course, all things remaining equal in this example, just looking at the theta decay only. And that's what it looks like on a graph. As you approach time zero, the percent of the premium remaining drops and drops and drops simply because time is running out. Now, if you're only buying stock options, remember theta is working against you. And here's a link here to this, this woman who spoke on CNBC, and I thought she made some good points. So the appeal for a lot of retail investors to buy options is that they're much cheaper, but your potential for profit is actually not that high. So what's she talking about? Well, let's look at spread trading like professionals do. She says an option spread calls for buying and selling different contracts. It's a common way for investors to hedge risk and volatility, and usually cheaper because you can offset your cost by the proceeds from different contracts. And it's been used by Wall Street professionals for decades. And in 2021, 11% of Robinhood's active users made options trades. And of that, fewer than 1% actually made multi-leg options trades. Interesting. So let's look at how professionals trade with multi-leg option strategies. Here's an example of kind of the basic, simpler strategy, simply a call spread. You sell an out of the money call spread here. That's the 45.50. You collect 4.5 points. You put that in your pocket, but simultaneously you buy the 45.70 call and you pay out 2.25 points. But the net result is you collect $112.50 minus your commissions, of course, and you put that money in your pocket and you sell that call spread, which is of course a covered spread. And you can do the same thing with puts. You sell this out of the money put. You buy an out of the money put spread below it to cover the risk. So you limit the risk. The net result here is you collect $100. And of course, like if we go back, you're looking in this example, the call, you want the market to stay below this level here. And with the put, you want it to stay above this level when you're selling these particular spreads. These are not naked options. These are insured. Maximum risk is capped and advanced. That's what you call a covered option spread. No naked creatures allowed, folks. Do not trade uncovered options. Do not sell naked options. I've never seen it work in over 30 years. It works for a time until it doesn't. And when it doesn't work, it blows up in a big way. So another advantage, if you're doing covered spreads, no margin calls, and of course, not unlimited risk. So you don't get chased out of the market if your risk is covered in advance. You don't have those margin calls where you're forced to close positions. Now here's an iron condor. It's just a combination of the put and the call spread that we looked at. It's a non-directional strategy. You sell an out of the money call spread and put spread simultaneously, and you collect the premium for doing so. And you look for the market to stay in a generally wide range here, at least in this example. Now here's our proprietary strategy. It's our short option strategy we created along with our technology, and we call it the Dragonfly. It has 6 option legs to collect premium. And it's a variation on the Condor. So here's what it looks like. I'll walk you through this here. We'll slow down just a second. You sell 4 of these calls. You buy 3 further out calls and 1 closer to the money call. And then same with the put, 4, 3, 1, same structure. And you'll notice the call that you buy and the put that you buy are, in this case, 50 points closer to the money compared to the 4 that you sold here and here. And that completely changes the dynamic of this trade compared to a Condor. There are unique bearish option strategies available as well. Something you can do just half a Dragonfly. So instead of doing the puts, you can do just the call side of a Dragonfly, collect premium that way. There's something we call a bear hedge. It's better just to look at the graph. You simply sell an out of the money call spread, collect the premium for that. And with the money you collect, you buy an out of the money put spread. So if the market has a large dramatic move downward, then the put spread you own will hopefully increase in value substantially. And the call spread that you sold will also move in your favor as well. So, but how do you do this? How do you know which market to buy and sell, what strategy to apply, the correct price, the timing? How do you manage your risk and your profits? That's a good question. I think Jackie Chan is perplexed there. So we're going to look at option strategies for all of these market conditions with automation. And that's where Theta Trader comes in. And we're going to run a demo here in just a second. We're going to look at our algorithm, creating theta trades, strategy automation, all market conditions, something called the risk thermal indicator for automated risk and profit tracking, simple and effective option spread creation and profit and risk management. So Theta Trader delivers these algo-driven option spreads for your portfolio, strategies for all conditions. And with that said, I need to switch screens. So bear with me, folks. All right, so if I've done that correctly, you're now looking at my Theta Trade dashboard. And if I haven't done it correctly, I guess somebody will let me know. I'll keep one eye open on the chat box there. All right, now you'll see here there are Theta trades available in this top section, your open short positions, any open long or bought positions. You'll see this is all of your account info here. This is would be your AltaVest trading account, and then your current price quotes. You'll notice too, there are bullish strategies that are pre-populated, bearish strategies, and non-directional. And you'll notice 3 markets that we focus on, and I will show you why we're doing these 3 in just a bit. But the E-mini, S&P 500, NASDAQ 100, and Russell 2000. So we're looking at the E-minis. But just a brief note, the reason why is because they're so liquid. So that's really the best reason if you're curious as to why. Now, we're going to look at a typical Condor. Let's start with that. You can see the algo has built condors for us automatically anywhere from 16 to 65 days till expiration. You can see the strike prices are all pre-selected. This is our maximum profit potential at expiration and our targeted annualized return at expiration. Let me point out that this number here and here both assumes, you get collect the full premium all the way through expiration, but we never hold trades all the way through expiration. And I'll show you that in a bit, and I'll show you why. But really these numbers here, especially this one here, this targeted annualized return, it's really here to compare one trade to another. We can't realistically expect to generate a 236% annualized return by doing this particular trade. So keep that in mind. Now, I'll just jump down here. Let's drill down. let's look at this particular condor in more detail. First thing I like to do is look at a chart. You can see the call spread that you're selling and the put spread that you're selling here. You look for the market to stay within this wide range in this case. And we won't go through all the details, but you'll see the net premium being collected here, 137.50, put risk, call risk, commission, cash required. Let's keep an eye on this here. Your cash required and your profit potential, targeted return on cash. Now, here's a question we get, and before I kind of mention that, notice here the put that you're selling has a delta of 9.18 or 9.81, sorry. That means there's over a 90% probability this put that's being sold will expire out of the money. And now with the call, 6.96, so that's over a 93% probability that this particular call would also expire out of the money. And so you can see why, if you're putting up $883, your maximum potential is 116. That almost seems like a asymmetric return for you, which is not favorable. But you're looking at the mathematical probabilities of this trade actually, and based on the deltas in terms of these options expiring out of the money. So they're very, very much highly in your favor. So that's the trick here, folks. And if you want to adjust the quantity, you can see here it changes the cash required, your profit potential. And then we'll leave the pricing here alone. We'll try to sell this for 2 3/4. We'll go ahead and place that order. You can see it shows up. And the demo account here just assumes that you're filled. So that's how that works. Now let me jump into a Dragonfly, and then I'll show you the best feature of all in terms of the dashboard. Kind of have a time machine where you can go backwards in time. Okay, let's look at some Dragonflies here. We just did a condor trade, and let's look at this Dragonfly. We'll look at this October end of month just to be different. I'm just kind of randomly picking trades. That's what I do during presentations. Usually try to pick something that has more time on it. Cool. So you see here, the Dragonfly has that different structure. It has an extra leg. Instead of 4 legs, it's 6. And again, you look at this call here and this put. So in this case, it's 50 points closer to the money compared to the 4 that you've sold here and here. And I'll show you why that's important. Now, since you're doing 4 puts and 4 calls, your cash required, of course, is higher than a Dragonfly, which we did earlier, that you saw it defaults to a quantity of 1. So 1 Dragonfly is always going to be 4 calls and 4 puts that you're selling. Profit potential here, your targeted return on cash, if you recall, compared to the Condor, it's a little bit lower. And also, of course, it's a different expiration as well. But typically speaking, the Dragonfly will have a lower targeted return on cash and a lower, essentially, profit potential related to your margin. And that's simply because you pay money to buy this call and this put. You're spending money on buying additional insurance. But however, you see the strike price for the put and call that you're selling. Again, 90% probability and 93% probability that these options will expire out of the money, the ones that you're selling. We'll go ahead and change this quantity to 2, try to collect 10 1/4 for each trade. And there you go. So that's what that looks like. That's how easy it is to place a trade with Theta Trader. They kind of serve it up on a platter for you. And let me show you the best feature of all. It's really right here. It's called the Trade Simulator. We can go backwards in time, and I've chosen a few trades already to save time. Let me squeeze this down so you can see more of the screen. All right, so here's an S&P E-mini, April end of month. We can use these buttons here to go forward in time or backwards in time. And you'll see here, day by day, how this trade is playing out. You can see the RTI is green, which means good, do nothing. And the color coding then turns blue, and that means take profits. And now you can automate this. So I will show you that in just a moment too, but keep in mind, you can automate it so that the order is automatically placed for you to close out this trade when the algorithm says take your profits. So that's a kind of a typical condor that works out well, and it turns out to be profitable. Now we'll look at that same end of month April on a dragonfly. I want to point out something here. Notice here, the date is March 21st with 40 days till expiration. It turns profitable. And again, you can automate that. So that was March 21st. Now notice here on the condor, you had to stay in the trade till April 1st before you had a profit taking signal. So that also is a key difference between the condor and the dragonfly. The dragonfly will oftentimes mature more quickly than the condor. And that's again, because you've bought this additional call and put here, and that changes the risk reward dynamic of that trade. Here's another condor. Let's run through. In fact, I'm not even sure. I don't recall what's going to happen here. Okay, it turns yellow, elevated risk, and you can see the trade is negative. The P&L is negative. I can see why. The trade's moving higher and higher, closer to that upper boundary there. And then look at this. Falls apart, turns orange, more risk, back to yellow, back to green, and then it turns red. Get out, too much risk, and you can also automate this as well. So if it turns red, too much risk, you can cover your losses and move on. Or if it turns blue with a profit, you can also move on. So the RTI gave a signal back on let's see here, let's go 1 day here. Yeah, you can see why. Too much risk right here. And let me, I wanted to show you that because I want to point out that we're not just cherry picking winners, really. No trading strategy has all winners. Now, here's a dragonfly. Let's run through this. In fact, I'll just go to the end. Now you can see here, this is interesting. Had you done a dragonfly, you had an opportunity to take profits on this 1 day, as opposed to holding on to it and ending up with a losing trade and taking the risk off here on red. So again, dragonflies can behave completely differently than condors. And that's the point I wanted to make by showing that. Let me show you this here. Here's another condor trade. Shows a loss here on December 17th. It's the end of month December. And the dragonfly, wanted to point this out, also took a loss as well. So the dragonfly didn't help you in this case compared to the condor. I wanted to point that out. Now here's a bear hedge. We looked at that briefly earlier, but let's take a look here. Go to the end here, and you can see that you had a profit-taking opportunity here on that bear hedge. Essentially, you sold this call spread, bought this put spread, the market dropped and gave you an opportunity to cover that position. And here's a condor. I'm not even sure what happens here, but I'm just saving time. That's right, this condor here, you end up with a loss with 15 days till expiration. However, had you had the dragonfly, you had a chance to take profits many, many days before the condor. So the point is, the dragonfly can be much more robust, give you many more opportunities to get out earlier, and perhaps even take profits when a condor does not. And it's not to say we never do condors, but the dragonfly is a very robust position. And this is how you do it right here, folks, to modify, I'm sorry, not modify, to automatically close out your trades with the risk manager. You check that button, the profit directive, you check that button there, save your settings, and then Theta Trader will scan your positions, then automatically close them out for you. Just that simple, folks. And let me go back. And I should also point out we have proprietary research here, but we have limited time, so I won't go into all that. We have video tutorials and video education as well. That's part of your Theta Trader. Okay, so let me show you really what the best feature of all is for Theta Trader. And for that, I'm going to have to switch screens here. Let's make it easier with our trade alerts. So these are the most unique trade alerts. You can really use these to rely upon in terms of having a trade pushed out to you. They're one-touch responsive alerts. You simply touch, accept, or reject. So that means these alerts are live and they're integrated with your AltaVest trading account. So you simply touch accept and your order's placed. And here's an example. You'll receive a text message with a link or an email, either way, or both. It takes you right to the page. You can see a screen here, a graph. You can see it's hard to see here, but you can see the trade is always pre-sized. So it's always going to be customized and tailored for you and your account. So the quantity is already pre-sized for you. The pricing is already calculated, and you simply touch accept, and that's all you have to do. Here's another example, a little more zoomed in here. It's a little older, but still the same thing. You get a description of the trade. You see the graph. And again, you can see here, this one's selling 10 of these condors. Tells you at what price, tells you what your risk is here, cash required, how much premium you're collecting, so on and so forth. And you just touch accept and the trade is placed. So let's get into the offer. We have a Theta Trader membership. We make a special offer available for the Mad Hedge event. So as you see, Theta Trader includes the Theta Trades, your risk thermal indicator, and the trade simulator. You can go backwards in time, yearly value of over $3,500. And then those one-touch alerts as well, that's all part of Theta Trader, that's included. So remember, those alerts are custom for you and your account. They're integrated with your account. All you have to do is touch accept or reject, either way. And then once you have that trade filled, then the RTI will automatically manage it for you if it turns red or blue, whichever occurs first. So that software valued at $35.88, the trade alert functionality, that service is valued at over $4,400. So an over $8,000 value for your Theta Trader software and alerts. But here's what really sets us apart, folks, is that we offer you the private attention. You have access to us. You'll be working with someone who's experienced and licensed as your co-pilot. You can discuss your trading strategy, your account, your trade history, whatever it may be. That's really an invaluable service valued at $7,500 plus at least. People spend tens of thousands a year on education, but you have someone licensed and experienced working with you alongside you. That's part of your Theta Trader membership. So all of that together valued at over $15,500. And of course, we can always add more as an infomercial, but wait, there's more. Remember, I mentioned the proprietary research. We do it every day, but I didn't have time to jump into that. Valued at almost $3,000. And then I mentioned the online tutorial videos. That's all embedded as part of Theta Trader. So you have the software, the alerts, the private coaching, and the research valued at over $18,500. And our retail membership price, $29.97. In fact, we used to offer it in in-person events for $4,000 and have people lining up in the back of the room signing up. But we're not going to offer that retail rate here. We're going to do much, much better, even better than this. 80% off that retail rate. And that's a lifetime membership, one payment of only $597. So that's just a one-time $597 payment. That's for your lifetime membership. You have access to the Theta Trader software and the trade alerts, and of course, us as well as your broker, someone licensed and experienced. Here is the link, cf.altavest.com/mad. Pretty easy one to remember, hopefully. So take a screenshot of that and you'll have that. And of course, that's my direct phone number if you had any other comments or questions. but usually people go right to that form and just sign up. We make it pretty easy. Hopefully we'll answer all your questions along the way in the remaining minutes here. But we do offer a 30-day guarantee. So you sign up for the membership and something changes in your life, then certainly you can ask us for a rebate, and that's fine too. Now let's jump into a few FAQs. How about a lower tax rate by about 10%? Yes, you can get that with futures and options because they're tax efficient. If you're trading these options with us, compared to like an individual stock option, we get preferential tax treatment. So in this example, I won't go through everything, but here's a 12.6% rate of return and a $7,400 tax liability if you're trading individual stocks. But if you're trading futures options, your tax liability drops to $5,360 and your rate of return moves up to 14.64, tax savings of over $2,000. It's a massive difference, really, just because you're trading a tax efficient instrument. Your gains are taxed differently because 60% are taxed at the lower, longer term cap gains rate. There's also no more itemizing. You receive a 1099 with your P&L on that. So no more itemizing and all the wash sales and so forth, but always consult your tax attorney or advisor, please. IRA, yes, you can do those accounts as well. We have a lot of IRAs with us. So definitely you can do that. Forbes says you can invest with self-directed IRAs. Absolutely, we can do that. Why E-minis? Well, they're liquid, they're efficient, and they're cost effective. And the reason why is they're big. The mini is huge. The E-mini S&P 500 outtrades all ETFs around the world by over 2.5 times. So you can see here compared to the SPY, almost 10 times average daily dollar volume compared to the SPY. And ETFs here globally over 2.5 times greater in terms of the average daily dollar volume that the E-mini, the ES in particular, S&P 500 represents. So 5 additional reasons for these E-minis: large volume, liquidity. So that means you get superior execution according to the CME white paper, cost savings of $4 to $15 per contract compared to the SPX. That means tight bid offer spreads. Large market share, densely packed strikes, 100 annual expirations, you get granularity in coverage. So what that means is when our algorithm is looking for strike prices to build those particular trades, it's going to find what it needs. So you can see the calls and puts here on a trade, and some time goes by, then you place a new set of trades here with the calls and puts, and some more time goes by, and another set, and so forth. So that allows you to keep your positions laddered. And remember, there's a big difference, and maybe you don't know this, but when you're doing these E-mini spreads, they're placed as one trade. So like a dragonfly, it's one order at one trade at one net price. You don't leg in. And with stocks, you can't do a dragonfly without breaking up that order into 2 separate spreads. And it's very inefficient. And I've seen people try it and it can't be done. So retail stock options traders, keep this in mind. Most retail investors only have access to the most basic call and put option strategies. They don't have access to option spreads or other more sophisticated strategies. So that's what we're giving you access to here with this Theta Trader platform and our solution. More advantages, of course, you're just tracking a few indexes, not thousands of markets, efficient margin, and then clear cost structure. I won't go into this too deeply, but remember, we're not stock options. So these all trade at the CME group on the Globex electronic exchange. That means every order goes to the same place and is treated equally. There's no payment for order flow. So no free trading like there is in stock trading, because it doesn't exist, folks. When you're trading stock options, it's all payment for order flow. And she points out most popular trading apps generate a lot of revenue from that payment for order flow. They can make more money from options than regular stock. So there's an incentive for them to lure investors into stock options trading. So look at Robinhood. They say they're commission free, but their orders are executed at prices inferior. They get fined. People try to save a penny, but they lose a nickel. I think that's a great way to summarize it. So it's just disguised commissions, that payment for order flow nonsense. So if you want a broker to work, pay a commission. I think that payment for order flow is probably on its way out, but anyway, it's nothing of value is truly ever free. I guess that's what I'm trying to say. So there's no payment for order flow nonsense when trading with us at AltaVest. Our commission rates are 5.25 round turn all in on the E-minis. Those are very competitive. This is a screenshot from a big brokerage firm, and they say their rates are only 2.25, but that's per side. So ours are quoted as round turn, and then they add more fees on top, and it's actually higher than what we charge. And of course, our rates, I should point out here, everything in Theta Trader is net of all trading costs, and it's a self-directed platform, of course. So you're placing the trades and you make your own decisions. So everyone has different results, of course. What size of an AltaVest account? Well, if you want to diversify with various dragonflies and condors, we suggest at least a minimum 25,000, 50,000 to 100,000 is probably better. And in fact, we'll rebate you. If you have a $100,000 account, you'll get a 100% rebate on your membership fee. If you do 50 to 100,000, then you'll have a 50% rebate. So people love taking us up on that. Different types of accounts, just like any brokerage firm. We mentioned IRA, individual, joint, corporate, LLC, trust. We get a lot of corporate accounts, you name it, trust accounts, individual, joint, all the above. So why Theta Trader and non-correlated alternatives? Why would you even want to do this with your portfolio? Well, they may improve diversification and lower portfolio risk, having alternatives. And that's really what this is, folks. It's an alternative approach, what they call an absolute return instrument or vehicle. And what are you diversifying from? Well, here's a summary. Some things, I don't want to look like I'm all gloom and doom, because of course it won't be this way forever, but median home prices now are down 6% in 2 months. The 40-year high inflation remains. Global energy crisis. Supply chains are worsening. Rising interest rates, slowing an economy that's already slowed. So recession may be the best case, but also maybe inflation. Maybe we need to worry about that, hedge ourselves against inflation to some degree. Look at this graph here. Central banks, the blue line, that's basically assets of the central bank. Money creation essentially. And of course, here's the S&P 500, the red line. So that's almost like 90-something% plus correlated. So meanwhile, the Fed's hiking rates and they're tightening and looking to reduce their balance sheet. So that's the stock market's probably not going to like that. It's going to choke. It's been choking. Here's the power of your consumer dollar in the last 22 years, dropping like a rock. Inflation outpacing wage growth. So even if you're getting paid more, it says here weekly earnings are down 4.5% adjusted for inflation. Here's what it looks like. Average hourly earnings dropping, and the real rate when you take into account inflation. So that inflation just picking money right out of our pockets, folks. And GDP forecasting being cut again. The Atlanta Fed cutting their GDP. This is Deutsche Bank. I think they call it a recession in April, and they're saying the pessimist will sadly prevail. That was just the other day. I mean, yes, I think they're right, but of course everything turns around. But I think it looks like there's still some downside ahead. Look at this one here. I thought it was interesting. They run real estate, billionaire investor here. Says CEO confidence is miserable. The economy is breaking hard. Says it doesn't care. The Fed will cause a serious recession. Look at this here. Liz Ann Saunders pointed out what we've been talking about. The Fed has never hiked rates before while GDP is contracting. So we're kind of in unusual space here. And in percentage terms, these rate hikes are very, very large. Average credit card debt soaring by 13%. Personal savings plummeting. Here's the yield curve, the 2-year, 10-year, inverted. That's a harbinger of bad things to come. I mean, it's no guarantee, of course, but we're already kind of in the middle of some, I guess you could say, some negativity. And that yield curve is maintaining itself negative for quite a while now, for over a month and a half. No sign of a rebound, and mortgage applications hit a 22-year low. So here's what's happening. Mortgage applications dropping. Here's the mortgage rate. This is interesting here. We all know it's been going up, but look at this. Just from 1 year ago, or 2 years ago, I'm sorry, the same home, the payment's now $2,370 versus $1,066. So that is huge amount of pain for the average American. Prices here, you can see 35% decreasing, getting bigger and bigger. Look at this, 2-month change in the median price of single family home, down 11.9%, worst in history. US housing downturn could be worse in 2023, according to Goldman Sachs. Household incomes are crashing. Anyway, I sound like doom and gloom over here, but I guess it's something we should all be aware of, folks. Household net worth fell 4.1% drop, among the worst on record. This is interesting too. Small businesses with positive earnings are plunging, firmly recessionary. And then this was interesting. CPI components up 22% year over year and 25% prior. So still very, very high. Retail sales disappointed again. That was today. So this was interesting. Non-seasonally adjusted initial jobless claims crashed to 53-year lows, lowest on record. So is that giving the Fed more incentive to hike rates because the labor market is strong? So here's what that chart looks like. And that's what this article is saying here on Zero Hedge. Not good news for bulls hoping for Powell to pivot, suggesting the labor market has never been tighter. So something to think about, at least. So 2022 has been the worst year so far for markets in 50 years. They're predicting minus 3.3% a year in the next decade. That'll be your average return. And let me see, I'm going to get to a couple questions and just kind of wrap it up here. You want to sidestep those drawdowns, try to avoid drawdowns. See these red periods here of time. You start the drawdown, but it takes, in this case, 6 years to recover after the tech crash and 5 years after the 2008 crisis. So you can see there are plenty of times in history where you can go a decade or more with really a sideways market. And you want to avoid those drawdowns. I mean, just doing the simple math, 40% drawdown, you have to gain 67% to get back to even. So it could be a lost decade for that 60-40 portfolio, getting clobbered this year. Look at this. I just pulled this today. Here's the Fidelity 60-40 portfolio, down 15% year to date. So you're not getting any diversification if you think you're going to get into bonds or something and diversify. So we like the alternative approach that AltaVest offers us. You should have some of your portfolio allocated into something that's not correlated, that doesn't always need a market to move up. And so you can see here, the Theta Trader gives you those pre-selected trades, automated management, those one-touch trade alerts. People absolutely love those alerts. Here is the link there. There's our phone number. And of course, to tie it all together is the personal coaching. There's really 5 simple steps. You complete that order form. You'll get your Theta Trader credentials. You'll get an email with your account opening instructions. And then once the AltaVest account is open, you just fund the account and begin trading. So let's see, I have some questions coming in. Yeah, we are AltaVest as the brokerage firm, that's right. So this is our technology that we develop for our trading clients. So you have an account with AltaVest and you would be using Theta Trader and our services, and you'd have a personal coach with AltaVest. If you're Canadian, you give me a call or send me an email and tell me more about your situation. Typically, Canadians can't trade with us, unfortunately. I wish you could. Average hold time, it's going to be, obviously very different. If you place a trade with maybe 60 days till expiration and things go well, you should be out of that probably within 30 days. Just kind of a ballpark, but again, it's going to be totally different depending on the days till expiration on the trade that you initially placed. But that's a good question. And let me see if there's anything else coming in. Yeah, people in the EU as well, give us a call. because depending where you are, we have a lot of people asking about that. We have a lot of clients in Australia and the UK, even people in the Middle East, so just depends where you are. And if there's any more questions or comments, so let me take another look here. Yeah, remember that kind of the big advantage to doing something like this is no screen watching. That's kind of the key comment we get in feedback. People will say, I love what you're doing. I can go on with my life and allow this to sort of run in the background and still have access to these unique strategies. They love the alerts and they love the fact that the risk and the profit is managed for them. And we've been set up well this year with bearish strategies. So far, so good this year. And we continue to remain, bearish for the moment. But again, that's what trading's about. You can flip on a dime. And there you have it, folks. So I welcome you to send me an email or just go right to the form there, get yourself signed up if you think this is a good fit for you. And we'll be glad to get you started and onboarded. But that'll wrap it up. Thank you very much.